You still can't hear me. All right. Well, it's on. Does that make a difference? Doesn't make much of a difference. Now that makes a difference. And I can get clipped. Yeah. Does that work? Okay. Nodding. Thumbs up. So welcome to the conversation about social impact bonds. We are trying to make this a very interactive session, so even though we're starting with people sitting on a Diaz in front of you, we're quickly going to move to small breakout groups, and we'll explain to you how that's going to work shortly. My name is Laura Calania. I'm part of McKinsey & Company, and I'm the lead author on the report, which you'll all have a chance to take with you on social impact bonds. We've got a great panel of folks who know a lot about this subject. So I'm just going to ask everyone to sort of give name, rank, and serial number, and we'll be able to hear a lot more from these folks about what they're working on shortly.
Great. I'm Kathy Clark. I am a professor at Duke University, and I run our Impact Investing Initiative.
Hi, everyone. I'm Kristen Janis at Nonprofit Finance Fund, of our Strategic Innovations Group, and I'm actually beginning to work on social platforms.
Summer Shaw, formerly at White House, now I'm also with the Tides Foundation, Center for American Progress, working on the Case Foundation on impact bonds and impact investment.
I'm Leo Quigley, Director of Social Finance, working primarily on the U.S. Department of Labor and Education Success Pilot Program.
Hi, I'm Amy Clement, and I'm the Year Network for Nonprofit.
Great. So what we're going to do is take about half an hour, 45 minutes. I'm going to present a little bit about McKinsey's research on social impact bonds. And Leo's going to talk. Kristen's going to share a few thoughts. We're going to hear some comments from Kathy and Sonal and Amy. Then we're going to move into breakout groups. We've got some work for all of you to help us do together, and that will hopefully make this a much more interesting and interactive session. So let me just jump into the McKinsey research. This is the results of about 18 months of work that we did at McKinsey out of our social sector office. Like I said, we have hard copies of the report available for you here, but if you'd like to access the report electronically, please go to the web address at the bottom of the screen. You can also view a webinar, download an article, see some other assets. In addition to this research, which is basically a market scan and sizing to look at the potential for social impact bonds in the U.S., we created two sets of tools. One is a diagnostic tool that helps you assess whether you're right for social impact bonds and social impact bonds are right for you. And the other is a due diligence tool. So once you've decided to journey down the path of SIBs, you can think about the strengths and capacities you are looking for in your fellow stakeholders. You can access those tools through the McKinsey website, or we partnered with Nonprofit Finance Fund, and the tools are available at the Pay for Success Learning Hub as well. The work that I'm going to share with you, McKinsey primarily financed. We designed the study and conducted the work, but we did have support from 6 foundations: Midair Network, the Rockefeller Foundation, the W.K. Kellogg Foundation, Robert Wood Johnson Foundation, the Hewitt Foundation, and the Heron Fund. We had a fantastic advisory group representing all the stakeholder segments in the SIG, impact investors, evaluators, folks working in homelessness and criminal justice. And we reached out to about 125 thought leaders and vetted our hypotheses with them, got their input to the research. So the conclusions I'm going to share represent the thoughts of a lot of people in the sector, not just a few McKinsey consultants who were into a room and closed the door. A lot of you may be new to social impact bonds, so I need to do a spoiler alert, which is this is not a bond. It's not a fixed income security or a debt security the way a lot of us are used to. And even though city and state government is likely to be involved, it's not like a municipal bond either. But this is a new and exciting kind of public-private partnership and a new way for multiple stakeholders to come together, which we think could be very effective in scaling solutions to social problems. So let me give a sense of so what for social impact bonds and the sort of problem they can help us solve. In 1964, President Johnson declared a war on poverty. LBJ said that our aim is not only to relieve the symptom of poverty, but to cure it and above all to prevent it. However, the majority of government programs are in fact remedial rather than preventive in nature. So these are programs that treat problems after they arise. The result is that 50 years later, the number of homeless people and incarcerated people has increased significantly, and the programs that we're providing to them still do not address the big problems. So just looking at the example of chronic homelessness, there are a lot of government-funded programs that address the symptoms of chronic homelessness by addressing medical needs through emergency room visits and providing overnight shelter. But this response is inadequate and expensive. There are alternative solutions to chronic homelessness, and one is called permanent supportive housing. PSH offers a long-term housing solution as well as wraparound services like substance abuse counseling and vocational training. Today in the U.S., more than 3,000 nonprofits are qualified to provide PSH, and they're currently serving 90,000 people who are formerly chronically homeless. But that means there are still 110,000 chronically homeless people who can benefit from PSH but don't have access to it. In 2010, at the federal, state, and local government levels, spending on chronic homelessness in the U.S. on remedial solutions was between $6 and $7 billion. So the question is, how do we shift this truly significant amount of funding from remedial programs to more effective, less expensive alternatives? Nonprofits have developed many types of programs that have proven to be effective, like PSH. They're not yet reaching all the people who need them. Philanthropy provides the risk capital for social programs, funding proof of concept, pilots, and even the evaluation that demonstrates if the program works. But philanthropy doesn't have the resources to scale these programs up. Government does have resources to fund programs at scale, but a lot of the government funding is currently tied up in these remedial programs. So how do we structure this handoff between philanthropy, the risk capital of the social sector, and government, the scale-up capital of the social sector? Well, one solution could be the social impact bond. Let me show you how this works. As I said, it's a multi-stakeholder partnership, so there are a lot of players. Today, under the current system, government is paying for these costly remedial programs, which deal with problems after they occur. But under a social impact bond, government would contract with an intermediary to deliver preventive programs that have been proven to work. Investors provide upfront capital to the intermediary to pay for these programs. The intermediary contracts with a nonprofit service provider to deliver the preventive programs. Service providers receive multi-year funding, which allows them to deliver programs at scale without worrying where their next dollar is coming from. When the process is successful, the preventive programs reduce the constituents' demand for remedial ones, which saves money for government. Along the way, there's an evaluation advisor monitoring the program's ongoing progress and providing advice about mid-course corrections if that's necessary. At the end of the life of the social impact bond, an independent assessor determines if predefined performance targets have been met. If the program's been successful and has met its targets, government repays investors and pays a success bonus to the intermediary and the service providers. So that's basically how a social impact bond works. Where are social impact bonds happening? Well, the first social impact bond is in the UK. It was started in 2010 by Social Finance UK. It's a $5 million SIB, £5 million SIB, which is a contract with 4 nonprofits providing services and vocational training to 3,000 infants. SIBs are also being explored actively in Canada, Israel, and Australia, and conversations are popping up in new places every day. I've had conversations recently with folks in Germany. The EU has done some study into this. There are conversations in New Zealand. We think social impact bonds are absolutely worth pursuing in the U.S. That was the focus of our research, and there are 3 main reasons why. The first is, as I just described, SIBs offer a practical tool for scaling social interventions. They provide a new model for scaling where one previously did not exist. Second reason, SIBs support government's goal of performance transformation by helping government to move from paying for activities to paying for results. SIBs move resources from remediation to prevention. Social impact bonds require alignment across government agencies, which helps to shift the system from a series of silos to a culture of cross-agency collaboration. And because social impact bonds measure results for people who receive preventive programs against people who don't, this requires comparison data, and we hope that SIBs can accelerate the adoption of robust data systems for the government. The third benefit from SIBs is that they reward the social sector's investment in what works. At the moment, funding is not always correlated to demonstrated impact, but by focusing on proven results, we think SIBs can help drive more resources to high-performing nonprofits and programs. But putting it in perspective, SIBs are just a tool, and like any tool, they have to be used properly. Based on the description I just shared, SIBs are relatively expensive. There's a need to be intermediary. There are evaluation costs. It's complicated because there are a lot of parties involved. So it's certainly a harder tool to use than a foundation making a grant or if the government agency were to contract directly with service providers. So this means that SIBs should be used appropriately, that you apply the right tool for the job. We think that means that SIBs should fund prevention programs, which deliver more benefits to society than the remedial programs that they replace. That SIBs should be used to scale proven programs, which have data to show that they indeed work. We don't think SIBs are the way to fund innovative new programs. Grant funding is ideal for that. And we suggest that SIBs be focused on program interventions that are scalable and replicable, so that they address the needs of a meaningful number of people in order to make the hassle of a SIB really work. So we do think social impact bonds are worth pursuing. We, however, identified a few enabling conditions that we think are important for their success. First of all, just to manage expectations, we need an education and communications effort so stakeholders understand their role and their risks inside of a social impact bond. Secondly, we think it's important that SIBs be kept in perspective. This is not a way for investors to get rich quick, and it's not a way to fund government deficits, but it's a great way to scale programs. Thirdly, there's a lot at stake with the first SIBs. People will be watching to see if they work, how they work, and if they're broadly applicable. So the first SIBs need to be constructed with care and precision, and people have to be willing to share their lessons more broadly for these early SIBs. And then lastly, for SIBs themselves to go to scale, they're going to need to become more standardized. At the moment, as they're contemplated, they're highly bespoke. And that's not a surprise in a nascent market, but to get to scale, to go from novelty to mainstream, SIBs are going to need to be a bit more standardized. So our research suggests that the U.S. is a ripe environment for social impact bonds. There are evidence-based social programs already in place, which are serving and going to scale. There's sufficient stakeholder capacity, nonprofits that are ready to get larger, groups that can serve the intermediary role, qualified evaluators. And there's a lot of momentum and interest, and we'll get into this in a minute. Kristen will talk about some of the structures that we're seeing, some of the activities that are happening in Massachusetts and New York City. Activities starting at the federal level where the Department of Labor and the Department of Justice are integrating community success concepts into some of their solicitations. So just in conclusion, social impact bonds are a tool. They're just one tool. We think that they represent a lot of elements that are important for tools to be successful in social change. They have a multi-stakeholder approach. They focus on prevention. They apply evidence-based programs. They pay for results and take solutions to scale. But whether or not SIBs prove to be the be-all, end-all tool, we think it's a very important conversation that people are engaged in and might lead us to some tool in the future that we can't envision today, but it turns out to be sort of our best tool for social change. So hopefully in the second part of our session, we will help us think a little bit more about SIBs and continue on this conversation and dialogue. So I'm going to invite Kristen Jantos from Nonprofit Finance Fund to come and talk a little bit about what she's seeing in terms of wherever you're comfortable. I'm going to sit down. If you'd like to stand up, you're welcome to do that. All right. Oh, I think there was my camera. Can I sit right here? Thanks a lot. That's fine. So I'm just going to spend a little bit of time talking about how this product, but I would like to talk about it actually more as an approach, is evolving here in the U.S. And what questions are coming sort of to the forefront or have been coming to the forefront over the last 18 to 24 months, which is about the time period that different players and parties in the U.S. have been really focused on this model that was piloted and driven out of the U.K. But the questions that have come to the forefront, I think, help us think about how different communities and different stakeholders are responding with different types of structures. So just as a little bit of background, because Laura referenced it as well, and for those of you who are not familiar with it, Nonprofit Finance Fund has been hosting and curating an online platform, payforsuccess.org, for the past year plus now, and we've really been acting to support the field development on this topic, but very much from an independent, sort of honest broker perspective, sort of heralding its arrival as well as calling out its challenges and
challenges and its gaps, and really recognizing that there's great opportunity in this, but that we really need to look for the appropriate adaptation to what are the different sort of fact patterns on the ground in the U.S. and at different levels of community and government. So I invite you to go to that resource if you haven't already. It's sort of just a repository for all information. It's just a very easy way into this topic. Let me just talk a little bit about these questions because I think they're helpful for framing that. And they really come from our experience doing training and education and just sort of advising different groups on what this model might be for them and for their particular issues they want to address. The key ones are the right stakeholders at the table, sort of where are the provider organizations in this conversation? That comes up a lot. Who gets to come into this conversation and when? How can we consider risk sharing to enhance market participation? How should we think about risk sharing as we're doing this? How are the structures and approaches best adapted to respond to the local market? What do I do with a model from the UK? What do I do with a model from New York City? I don't have a city government. I was in LA yesterday, so I got a really good view on this. I don't have a city, that's a county, that's a school district, that's a funder in a way. I mean, it's a very unique market. How do I adapt that to my hometown, my setting? What might the future of SIBs, or as we're sort of more broadly calling it, the pay-for-success market look like? Is this a market, or is this a tool that we're sort of using in the moment? And what would really have to be considered in order to balance all these competing yet mutually interested parties and have them be at the table successfully over and over again? So I just lay those out because as I start to talk about the different transactions in the market, you'll start to sort of see how people are responding in different ways to those sort of key framing questions. I would say that we have definitely moved in the U.S. from a point of exploration and learning and conversation to doing, and that's really very exciting that we actually have deals that we can start to look at in the market. And I think that I expect that this will be accelerated for a number of reasons, and I also think that the only way to really understand how to execute this kind of an approach is to actually do it. They're just so complicated to stay in the theory, to stay up here, it only gets you so far. And it was very interesting that the market moved quickly and within 24 hours in the first week of August. So in the first week of August, we had, it was on Tuesday, announcements out of the state of Massachusetts that they had announced 2 SIB contracts. So one of the contracts is addressing youth aging out of the juvenile justice and probation system. The second is addressing chronic homelessness in the Boston area. And right now these are contracts awarded but not funded. I think that's an important distinction. So we don't know the investor side of maybe others do. Publicly, we don't know the investor side of these contracts yet. But a little bit on, this is going to sound nuanced, but there are important distinctions around the structure. In each case, you have both providers who have been named, who will be either managing the delivery and or delivering the service to the identified populations. And you also have a financial advisor acting as intermediary, but in partnership. So it's a slight difference than what we've seen out of the UK in the initial model, but it's just worth noting because there was a lot of discussion when these contracts were being formed about how that partnership would be managed, and the state has chosen to sort of look through to the providers of their award. Right now, we're not sort of clear on the investor side of the picture yet. The anticipation was that it would likely be philanthropic money coming to the table, but I don't think that we can rule on that until we see how that unfolds. Going back a little bit, the state took a very methodical approach. They established legislation in order to be able to do this. They issued an RFI, RFPs. It was very methodical, and I would say in a way has placed this model and these pilots inside what they're articulating to be a larger social innovation and social finance infrastructure that they're trying to use within the government. So in that way, I think it was a very intentional approach that they took over an extended period, almost over a year. The second 24 hours later deal that came to market was a funded deal, and the New York City announced a $9.6 million contract with Goldman Sachs to address issues of recidivism and about 3,500 adolescent men coming out of incarceration on Rikers Island. And this was, I don't know about all of you, but somewhat of a surprise to the market. Some of the parties weren't known until the very last minute, but very interesting structure in the ability to sort of bring in a commercial investor right from the start. We won't ignore the fact that there is a guarantee in place from American Philanthropies, 75% of the principal, but notable nonetheless, even with that guarantee, and I would say for a couple of reasons. One, the group inside of Goldman that actually made the investment is their urban investment group. Again, these are nuances, but I think important ones. This was not from the private bank side. This was not sort of friends of friends necessarily. This was a group that is used to lending into community development activity. This is a group who knows how to underwrite deals and has a mission focus on doing that, so to speak. And it caught the attention of other commercial banks who are in the community development financing business. We've had a couple of calls saying exactly what is this product that Goldman has invested in. So that shouldn't go ignored. That is important because I think in a way it may leapfrog the market a little bit in getting other commercial investors in the form of banks and CRA regulated banks into this product. I also will say, obviously, that the guarantee is very significant. There's no getting around that. But it also probably allows, given, we'll see how the project unfolds, but if they are able to meet their outcomes, the sort of need for a 75% guarantee will decline over time. New York City is very committed to the model. They just issued an RFEI, Request for Expressions of Interest, held a meeting last week where I think they had over 100 people in the room, and what they're really looking for are ideas for the provider community on more models where they could apply the social impact bond structure. And they are really looking to try and get at least 2 more deals done before the administration closes out in next November. So those are the two localities where there's live deals in the market. I want to mention one other location that has a model in the market that actually predated when we all started talking about SIB in the U.S. and it has questions?
Yeah, I didn't want to break your thoughts. We were allowed that stuff right now.
We're going to hold questions.
Okay.
Kristen's going to talk. Leo's going to talk. We'll take a few questions, and then that's an opportunity for Kathy and Sonal and Amy to also weigh in. We'll go through them. You'll have a lot of opportunities for questions and discussion in your small working groups for the second part of the session.
And I won't take too much more time. In Minnesota, they passed legislation a year ago for something called the Human Capital Performance Bond. This is actually a bond, unlike the ZIP. And it's an appropriation bond, so it's issued by the state. There's a couple of distinct differences in this. That the nature of when the capital flows is not upfront as it is in the SIB structure, which is really a very important part of the SIB structure. It actually flows to those organizations once they've hit those outcome targets. And so, in a way, that's a flaw, and there's a lot of conversation going on about how to structure around that. But I think it does something rather interesting in that it operates within the existing capital markets. It taps into a very established and supported investor base, and it just should be on everyone's radar. It doesn't necessarily mean it's one or the other. It is a way of talking about, is there a possibility here in the U.S., because we have such an active municipal market, are we able to sort of move this product SIB into something that is sort of more mainstream in the capital market? So it's just sort of something on the radar. The other things that are going on that are also really very important is what's going on at the federal level. So the Department of Justice and the Department of Labor, both looking to incentivize pay-for-success activity through existing programs. One through the Second Chances Act, which they just announced their awards yesterday or today, and then the Department of Labor through the Workforce Innovation Fund, and their solicitation is out there with applicants
to be submitting their applications by the middle of December. So I'm happy to talk in more detail about either of those or any of this later, but I think that kind of gives you a sense that there is activity at all levels of government in the U.S. And interestingly, I think it's one of our questions in the FAQs: who starts the process? How do you drive this? There was a quote I read just yesterday of Toby Apple says, "This is really a moment where everybody holds hands and jumps," and that is true. But government must be standing there jumping first, or jumping simultaneously.
Great. It's fun to be back at SOCAP. This is my third time here, and actually the first time I was here, I saw the presentation from Social Finance UK on social impact bonds. That was a very interesting idea. And back to the Boston Foundation, where I made a grant to Social Finance US to get off the ground, and now a little bit later, I'm working with Social Finance. I've been on the team for about 6 months, trying to get these off the ground. So I'm here to just talk a little bit about a work in progress. Both Laura and Kristen mentioned that the U.S. Department of Labor has a Pay for Success competition running now. I'm running our response to that. We were selected by New York State to help them put together a response, which is focusing on using transitional employment strategies for fixing recidivism among ex-offenders. So we're really starting, and the nature of this competition is such that we need to have a fully baked social impact bond proposal put together by December. So in a very short space of time, we're really working to meet the needs of the providers, government, and investors in a very fast time frame. So the two that were mentioned, the Department of Justice Second Chance Act and the Department of Labor's Workforce Innovation Fund, they are a subset of a larger set of initiatives that the Obama administration originally put forward, something like $100 million in pilot proposals that were not appropriated, but the agencies found other resources to do some pilot programs and agencies. The Department of Labor opportunity is a $20 million offering. They're expecting to select 2 to 3 grants. The Department of Labor is targeting hard-to-employ populations, which include disconnected youth, homeless, ex-offenders, long-term unemployed, veterans, and so the connection, from my perspective, I'm working on a program that's aiming to achieve savings on the correction side through an employment plan strategy. Immediately, we're dealing with different agencies within the state of New York, trying to achieve coordination across those. And again, we were selected as the intermediary only in August, so we have until August to put together a proposal. And what's very interesting about the New York opportunity is that recently New York merged parole and corrections, and the governor has stated a goal of moving that system from one that's primarily about supervision and corrections to reconnecting people with communities and employment. So it's a very forward-thinking approach about using programs like this to connect people to labor opportunities and return communities. And so the kind of interagency collaboration that we're seeing is great, and a very interesting application for us as a pilot like this. But then just to go back to that, so we're proposing something to the Department of Labor that's the primary goal, or primary result is to achieve savings in the Department of Corrections, and that those savings primarily come to state prisons, local jails, victim costs, transitional employment benefits. So we're working to identify what mechanisms for measuring all of those, and yet providing something that offers investors a simple and straightforward metric for understanding how they can pay. So there are a few challenges I want to mention about the work we're doing. One is from the state perspective about really how to assign value to this. The RFP from the federal government requires a cost-benefit analysis to show that the overall program is achieving savings for governments at various levels, which forces a certain approach to thinking about what the value of the objective is, what the value of the outcome is. So we're looking at things, counting prison bed days that are avoided, victimization costs, some of the value of employment, and yet that doesn't come close to measuring truly what social value of a person might be, or connecting someone to a community. So we're, by nature of the RFP, focusing on some of the very straightforward budgetary questions. We've seen in New York State that the average cost of putting a person in prison for a year is $46,000 a year. and an effective program intervention might be $10,000 range. So we're working very closely with the department budget to identify where the savings come from and how they can be documented. And also, we're working with an intervention that has a randomized controlled trial behind it, which has an interesting dimension of sort of fixing the expectation of the outcome based on that study, which is a little bit, makes it more difficult to pose innovations around that and to suggest how the outcomes might differ or improve over time. So there's a way in which both a randomized controlled trial history and the cost-benefit analysis requirement has a way of narrowing the conversation in ways that are typical of what Laura mentioned, to the ways that social psychon is a community place where that's happening. So, unlike some of the other transactions you've heard about, we are focusing primarily on attracting commercial investors to this deal without a substantial guarantee. And that has several implications for the way we're approaching the structure of the transaction. One is that these investors want a very high probability of return of capital, naturally, which puts us in the position of being somewhat less aggressive in terms of estimating outcomes, for return of capital, and then structuring an escalated payment structure so that they outperform shortly, they achieve the maximum amount of funds available from the Department of Labor. So that's a point of tension at some point with the state in terms of where we set the level for break-even for the investor. It may well be less than optimal or the best practices from that program. But we are, and also because we're working with this target audience of investors, we're really moving toward an intervention with a strong evidence base behind it, with the randomized controlled trial approach, and that the investors also are eager to see a very simple payment metric, which is difficult to achieve when what we're actually creating in terms of value is avoiding prison days and avoiding victim costs and labor outcomes. So to the extent we're trying to boil all that down into something that's both simple and understandable and has some history so that investors can understand the variability of that payment metric over time. Those are the challenges that we're working through now. And then finally, I'd say something about the challenges from the provider perspective. As Laura mentioned, the access to a substantial amount of operating capital for scaling is very attractive. The due diligence associated with putting social impact bond together is a very new experience for the provider. Even one with a randomized controlled trial history still needs to do some extra analysis to show that those results have been maintained over time, to see what those trends are, to that they want to make the case that they've made changes since then and the outcomes. We need to document that. That involves data matching between the provider records and state agency data and access. So there's a very data-intensive process to make a case that's different from the RCT, more recent, and also to establish the history of variability around any payment metric that we might propose. So the state provider and the investor all have slightly different views on what the best thing to measure an expenditure program. So we're navigating those waters as well. So I guess my goal here was just to sort of give you a flavor of some of the tensions that arise as we're trying to balance the interests of the three parties at various states, providers and investors. And just stay tuned. So we're moving forward toward this position. And hopefully February, March election.
Okay, great. So welcome to the people who've just come in the last few minutes. What we're going to do now is take a few questions from the audience, and what we'll do is hear the questions, then invite Kathy, Sonal, and Amy to give their reactions to what has been said so far, help to answer the questions. Then what we'll do is take a good 45 minutes or so, 45 minutes to an hour, and break into small working groups to provide more basic information for people who feel like they're still a bit new to the conversation about social impact bonds, For those of you who have already been thinking about the topic for a while, we've got a job for you to do to help answer some frequently asked questions that the Center for American Progress is organizing and that the Nonprofit Finance Fund will publish on the Paper Success Learning Hub. So, sir, you had a question. You want to just share that? Okay, great. Anybody else would like to lodge a few questions? Yes. Sir.
Hi, Jared. I'm from Calgary. So we've been looking at social impact on related to homelessness as well. And I'm wondering, in the case of the Massachusetts example, and the case of the New York example, can you tell us what the success measure was and what the time frame was to make it measurable?
Okay, so that's one question that panelists will try to respond to. Other questions that you have, sir?
So it has to be only institutional investors that can invest in this particular kind of social impact bonds?
Okay, so we have an investor question. Maybe Solo will take that one. Other questions? Yes.
Has anyone looked into using the primary beneficiary from capital perspective, the corporation or some other entity goes to the government?
Okay, so maybe Amy will talk to that. Other questions? Yes. Okay, so other social sector activities. Other questions? All right, that's a great start. So we'll just maybe start with Kathy, Sonal, and Amy. Share what's on your mind based on what we've said so far and try to address some of these questions.
Great. So I guess there were two things on my mind. One of them relates to one of the questions here. One is I just wanted, I think social impact bonds is a difficult thing to have a conversation about in some ways because there's so many kind of new technical working parts. You know, McKinsey did a graphic so we can all understand it now, which is fantastic. But it's still a complex conversation. But I also wanted to point out from the point of view of people working in social change and looking at the power of enterprise and engine to create social change in different ways with investors and intersecting with that. I think what we're in the middle of, I'm just going to step back and give you some perspective, I think we're in the middle of a really important new kind of conversation. A new kind of conversation that is actually focused on outcome as the point of departure, right? That organizes everybody, as opposed to kind of what kind of capital do I have, or I want to do it this way or that way, or short term or long term, or I want to invest in mid-density stage, right? All that is kind of a race, and we're talking about what does it take to get these men to have to and I think that the power of what we're witnessing through what's probably for the next 3 to 5 years is going to be a time of experimentation, right? Some are going to go one way, some are going to go another way, but we're going to learn about how to have that conversation, which I think is really, really important. The second thing I wanted to think about a little bit is the role of the investor. And so, what we're experiencing now is there's one model in the UK, and now there's kind of 2 existing models in the US, and hopefully very soon, given these new things, we're going to have another series of models. I'm guessing, this is a prediction when you come back next year and see if I'm right, what I'm guessing is that this might start to bifurcate a little bit into a series of experiences where people are pretty confident, right, about the kind of risk that's involved. Data is good, the processes have been done before, and more kind of commercial capital might be coming in, including individual capital, right? Or right now has been very institutional because it takes all this time to kind of get to know it. But I think there are networks on the Shared Investor Circle, the Working Botanic, there's all these other networks of people who are looking for good stuff to do with their money. I think this could become very attractive to them fairly soon. I also think that there's probably going to be, as we step away from recidivism and homelessness and start to step into some other areas where the data may not be as good, there's probably always going to be another kind of experimentation going on where that philanthropic subsidy is essential. What I hope will happen over time is that we kind of get really good at sorting these things. And it becomes much more clear kind of what categories will be those and environment processes can occur around those points.
So I'm going to just probably stick to answering the questions because it'll be easier when we can talk about smaller groups about more detail. I think Kathy kind of took on the institutional investor question. Was that your question? Okay. Okay. Regarding the Calgary homelessness, I think Leo probably has more details on it because they were in the video more specific But what I'd like to talk about is whether the primary beneficiary has to be only the government, or and the other where there are potential topics, other topics. So primary beneficiary does not only have to be the government. Certainly, we're seeing some potential ideas in California on healthcare that the primary beneficiary is the insurance company that's money from the government to run Medicare and Medicaid. So there's ways of thinking about that, but I think one question that we should ask ourselves is who's making sure that the general good is being served if it's not the government? What's the protection in that? And there's a question as to how that's done, but it does not have to be the government. And certainly, I think a couple of places where people are thinking about this, the primary beneficiary will not be the government. So there's a way to think about that, and I do think there are opportunities to talk about this. Regarding other topics, one is healthcare, especially in prevention in healthcare. We don't spend a lot of money on prevention, largely, especially in the United States, but in general, prevention has a real opportunity in healthcare. There's potentially opportunities in early childhood education. There are also potential opportunities in other places. People are looking at internationally in healthcare and in other spaces also. But I think the number one issue here is making sure we have good data. Because it may be that SIBs are the right tool, but it may also mean that the SIBs are not the right tool if we don't have the data. I don't think you want to use SIBs for everything if you don't have the data and good interventions and information on whether something's working or not working. And that not having that data is not the right place to do a SIB, but it might be another innovative financing mechanism that you might want to look at. So it's important to look at those. Different governments, and the ones I gave were the ones where we know in the U.S. there's data. Different governments may collect different data in different parts of early childhood education is big here, but in France it might be that high school education is really good data and you can do that. So it really depends on where you have the data. For us, the ones I gave were probably US-based ones most specifically. And then I think we can talk about the other issues, but the primary bank, I think we get to two.
So I have a question because I'm interested in who's here and who's interested. So as Kristen said, putting together these kinds of partnerships requires everyone to hold hands and jump off the plane together. And so just wondering, would love to see everyone in the room who's a funder. Could you just stand up just to get a sense of, or raise your hand. Or raise your hand if you want. Investor, funder. Yeah. Okay. And then everyone who's a service provider. Thanks. And anyone from government? Good. Thanks. I'm glad to see that we do have representation from all across because it is, it's unclear sort of where and how these things are going to start. Thanks for that. I just wanted to reinforce two things perhaps that Sonal had touched on. One is looking at social impact funds from an international perspective. So there are conversations going on, primarily being out of Europe right now, and also the Center for Global Development has really been taking the lead stage on driving some of these conversations around how can you use this model, this kind of partnership in the global development context. So where the beneficiary is not the government, but perhaps the payer of services would have been a multilateral or a bilateral, which is another interesting take on these kinds of contracts, yet as another player to that complex graph that we saw earlier, something to think about. And then the other comment that I wanted to make was just around the data piece, where if you think about what's required to make one of these things successful, clearly having strong measurement and evaluation to determine whether or not a payout occurs. In order to do that, you have to have a baseline of data and you have to have really strong systems. And unfortunately, oftentimes we find that the government doesn't have strong systems. And so I think one of the sort of preconditions for making these things happen will be better systems within government, and hopefully, there can be some sort of movement together of these things so that we can bring more SIBs to life.
Okay, great. So I'd like to just add on to the question about how do you know what type of opportunity is right for SIBs, for social impact bonds, and just building on what Sonal had already said. We've been thinking about it that it's not so much the program area like health or education, and it's not even so much the nature of the problem that you're trying to solve. It's more around the nature of the intervention that you're going to scale up using the social impact bond. So we think behavior change interventions are particularly appropriate for the social impact bond approach for scaling, as opposed to a social good or service where some variety of a market mechanism could be satisfactory. So what do I mean by behavior change intervention? Where you need case management, wraparound services, ongoing support, and extended study to tell whether or not the intervention is working, we think that's where a social impact bond applies. So if a person needs 4 walls and a roof at an affordable price, there are subsidized housing opportunities that are available, and that looks really different from if they need permanent supportive housing, with a caseworker, vocational training, substance abuse counseling, etc. So there are more market-like approaches that make affordable housing available, but the SIB is, I think, uniquely designed to make something like permanent supportive housing available for folks. Okay? Yeah, let's take a couple more questions, and then we're going to break into our working groups. Yes?
One of the messages we can see on my mind, what you just said, that it's around long processes. What's always in my mind is the prevention aspect early on.
Yeah, okay. Absolutely. We believe that SIBs are best to scale preventive interventions, because that's how you can generate some savings in the system that allows you to make payments to these important actors like the intermediary, the evaluation advisor, etc.
Is it now we're running a subset of only prevention that the nature of the intervention is more longer term?
I would suggest preventive programs that are built around behavior change interventions. Okay. All right, so what were, yeah, you saw something else?
Question, our very first question. I'm sorry. But I think you were asking about what was going to trigger, how they were measuring performance, and
how they measure success, and
we have a little bit of information. I just want to be able to put that out because I think that always can really complex, so tell me how it's going to work. I don't think we know actually in the case of Massachusetts where the homelessness project is happening because they haven't negotiated a contract. Right? There isn't an investor in, so they haven't negotiated the terms. So
What happened last year was simply an invitation to negotiate one for the program.
But in New York City, and yeah, I know. Sorry, I get it wrong.
Hi, I'm Andy Phillips from Goldman Sachs, and I led the investment in the Rikers transaction. So the 2 metrics there are an initial 12-month recidivism, and it's based on days returned to jail, not just ever coming back to jail. And then the final measuring is around 24 months. The initial 12-month benchmark really is sort of the go or no-go.
If you hit your benchmarks for government, the whole thing about the hierarchy, how do you get the law to shut it?
Sure. So the way our structure works, I think Laura's picture is perfect. MDRC sits in the middle. We made a loan to them for $9.6 million that we fund over 4 years quarterly. They use the proceeds of that loan to pay the service bill. There's an independent evaluator. Based on the results, that independent evaluator finds the City of New York pays MDRC, which they then use to repay us. At the same time as we're funding our loan, Bloomberg Philanthropies is funding the guarantee fund that sits in MDRC. In the event that we don't hit our benchmarks, there's a schedule on what portion that we recoup through the guarantee fund. So in the worst case scenario, we fund for 4 years, don't hit any of the benchmarks, we do get a 75% guarantee. We don't believe that's going to happen. What we believe is going to happen is we are going to hit our benchmark in our base case is around 12% reduction in receipts. At that point, we will get our capital return, a very modest return. And what will happen to that guarantee fund is it will sit within VRC as a seed fund for future social impact projects.
Okay, so now what we're going to do is pre-qual to work. And so you don't have to just listen to us talk and try to answer your questions. As I described, the Center for American Progress with Sonal and Christina's leadership have put together a set of frequently asked questions and the answers to those questions. We'd like to vet some of those with all of you to get a sense whether you think the questions are good, the answers are clear, if there are ways to improve them, if there are some other questions that you think are burning that need to get answered. We're going to do that by breaking into some small groups. We also are going to offer a session for people who feel really new to social impact bonds, where you just want to understand again the little picture about how it all works and what the roles are, and you've got some basic questions. And Leo and Beth will lead a conversation, sort of the 101s on social impact bonds. But if you feel like you know the 101 and you want to help answer the frequently asked questions, Beth's going to tell us how we're going to organize ourselves to make that all possible.
Can everybody hear me?
Yeah.
All right, so I know it's after lunch, everybody's really tired, so now we get to stand up and shake out a little bit and get a little more energy. So what we're going to do is you're going to stand up. First question is, how many people think they want to do the 101 session? Please raise your hands. Okay, so those folks who are doing the 101 session, you're in the back corner back there with me and Leo. Everybody else, stand up and organize yourselves around one of the facilitator tables that are on the outside of the room. You're going to create a bunch. You're going to get some materials, some pens, the reports, and your facilitator is going to walk you through the questions. And go.